Hey everyone, Richard here. So in this video, I'm going to share with you how to build a £1 million pension by investing in property and building a successful property portfolio. For those of you who don't know my personal story, my dad worked for Barclays Bank for over 40 years. And at the end of his working life, my dad got made redundant with a £1 million pension. Now, up in the top left-hand corner now on my screen, you should see my dad's pension statement coming up, because I want to share with you the exact figures that my dad got off a £1 million pension. Ultimately, why am I sharing these figures with you? Really for two reasons. One, because everything I share is from a place of authenticity. It's the exact things that have happened in my life and manifested, which has taught me lessons along the way. And I want to share those authentic lessons with you. And secondly, everything I say, I'll be able to substantiate. And also, I think at the same time, with that being said, when you look at the numbers and break them down, I think that people think a £1 million pension is going to pay them more than it actually does. So here's my dad's pension, top left-hand corner of the screen. So my dad's pension was worth, at the end of his working life, my dad's pension when he got made redundant was valued at £1,178,417. Now off of that, my dad would have received a gross income of £36,573. Now, when we take off taxes, is 20% taxes on that number, you end up with an income of £31,759 per year, right? Which ultimately pays my dad a net income of £2,646 a month. So it's okay, but it's not amazing. It's not going to change his life and give him the retirement that he wanted to have, right? And I think everybody watching that video will agree. So ultimately, that was one of the reasons that initiated us to start building our own property portfolio, so that we could basically scale his pension and give my dad a better retirement. And at the same time, I wasn't very happy in the corporate world. So we also built a portfolio that enabled me to get out of my corporate job, replace my corporate income, which at the time was £100,000 a year, which paid me around £5,500 a month of net income. The goal was to help my dad scale his pension, at the same time build a property portfolio that would enable me to quit my job and become an entrepreneur and follow my passion as well. Now, I'm very grateful that I've been able to achieve that, which is one of the reasons why I'm sharing these videos with you. And I have a video as well on my channel, guys, as well, right? That's how I brought my first 15 properties. And ultimately, the first 15 properties that I brought enabled me to become financially independent. And those 15 properties paid more than my dad's £1 million pension. So that was part of my £1 million pension strategy as well. And so you can go and check that out after watching this video, and there'll be a link to it at the end of you watching this video, right? Now, I created this video really to show you what I would do if I had to do this all over again. So if I was to start from complete scratch again, I'm going to share with you the exact strategies that I would use to scale the portfolio, how many of each property type I would buy and strategy I would buy in order to achieve that £1 million pension. Now, for those of you who don't know me, my name is Richard Norris. I've successfully built a multi-million pound property portfolio. My group of property companies does over 100k a month. Now, with that being said as well, if this is the first time you've met me, you'll get to know that I'm a big fan of diversification. So when building a property portfolio, for me, the key fundamentals are stress testing and diversification. That enables me to scale the portfolio in the most basically time-effective way, but at the same time, in a way that's strategic and allows me to do risk profiling to manage the downside of my investments. Because I never want to get to a position in my life where I scale it to a point where I'm financially independent. I haven't thought about the contingencies and I have to go and do it all over again because I've lost everything, right, that I've built. So I build my portfolios out very conservatively. And so numbers is everything for me. And I've built something called the asymmetric model, which kind of helps you to understand how I build my portfolio to get the best returns in the safest way possible, right? So I'm going to share that with you here. And this kind of all manifests into the plan that I'm about to share with you. Now, the first thing you have to think about when you're coming up with the strategy and the business plan for what do I need to do? How many properties do I need to buy to create £1 million pension? The first thing you need to think about is what strategy you're going to deploy. Now, I'm a big fan of keeping things simple, and I want to kind of basically do the least amount of work I can for the maximum reward. Now, for me, like buy-to-lets, vanilla buy-to-lets, using a buy, refurbish, refinance strategy and repeating that cycle has been a big part of what I've done and a big part of why I've been able to achieve financial independence. And so my first strategy that I would do is exactly that. I would do buy-to-lets again, and I'll keep churning them out on a model that's repeatable. The second strategy I would use is HMOs. And the reason why I like HMOs is because I think there's always going to be a demand for HMOs, especially because, especially in a situation at the moment where inflation's at an all-time high, people are always going to need a place to live. And actually, when things become unaffordable, the cheapest places to rent are your HMO models. So therefore, you kind of cater for a mass model. And I think that it's a really solid strategy. And also, you can kind of create like £1,000 in net cash flow a month. So you don't need to buy as many properties to achieve a higher income figure, right? So again, it's about that balance of being effective, doing the least you can to achieve maximum output. HMOs is a good strategy for that. But having a blend of buy-to-lets and HMOs, I believe, is the perfect diversification. And the reason for that is because when you do HMOs, you'll find that you get quite a high turnover and tenants don't really tend to live there more than 12 months. I mean, I have some tenants in my portfolio that do live in the properties more than 12 months, but ultimately on average, tenants stay in those properties for sort of 6 to 12 months. So you end up with a higher turnover, and therefore you do get a few voids with HMOs. And having that buy-to-let strategy, which is a lot more solid, you end up with people on longer term ASTs, so they stay in the properties for longer, and that helps to balance the cash flow of the portfolio. Now, I've done everything from buy-to-lets, which is, again, I'll turn those single lets, through to HMOs, through to commercial to residential developments. And they're really the three strategies that I deploy and continue to deploy to scale my portfolio today. Now, with that being said, as part of my first 15 properties that I brought, I did single lets, HMOs, and ultimately I did a commercial conversion as well, which you're going to see if you watch that video. But if I were to do it all over again, I probably would drop the commercial to residential development. And the reason for that is that it's a big step up. And frankly, I wasn't really ready for that step up. And I kind of underestimated how big it was, the step. And secondly, it takes a long time to do, and it's very cash hungry as well. So you end up with 12 months of cash going out of the bank before you kind of see your first returns, which at the start of your journey, I don't think it's the best thing to do, right? You want to turn over as many properties as you can and start to build that cash flow as quickly as you can. So let's jump into the numbers and show you what I would do and the strategies, like I say, the buy-to-lets and the HMOs, and help you to calculate how I think about this and how I would create that plan. So I would effectively, the first thing I would do is I'd buy 10 buy-to-let properties, okay? Now, I invest up in the northwest of the UK, around Manchester, Liverpool area, and I think it's a great area because you get high yields and you can buy properties that are relatively cheap and have high rent ratios, so you get a really high gross yield, which enables me to ultimately sweat that buy, refurbish, refinance model and get the maximum for my money. I'm basically making my money work as hard as I can by investing in those higher yield areas. And ultimately, to deploy a buy, refurbish, refinance model, you do need to look for those areas of higher yield, right? I live in the southeast in Oxford, and buy, refurbish, refinance for a buy-to-let model, it just wouldn't work because the yields are too low. Now, so I'd buy 10 buy-to-let properties, and I'd buy them around the north of the UK, okay, where you've got those cheaper properties. And I'd buy sort of two bed to 3 bed terrace properties. Now, if I brought 10 buy-to-let properties, roughly the net cash flow that I get from the 10 properties is around about £250 a month, right? Now, that's 250 after all expenses paid. So that is your absolute bottom, right? That's rent minus all your costs, gives you a net cash flow of £250 a month, right? So put pound sign there, £250 a month. Now, if I do 10 times 250, I basically get 2,500 a month of net income off those 10 properties. Now, I typically would allow £40,000 per property as the amount of cash that I need to invest in order to achieve a net cash flow of £250 a month, right? And the reason I would allow that is because I'm saying roughly on average, in the north of the UK, let's take between a 2 and 3 bed terrace that they'd be valued at around £100,000. So you put down a £25,000 deposit, plus your legals, your stamp duty, and also maybe allowing, say, sort of 10,000 in your figures for a refurbishment as well to enhance the value as quickly as possible, and then refinance the asset so that we can move the money on and continue to scale the portfolio. Now, if I take that 40,000 and I times that by 10, that would mean that it would cost me an investment of £400,000, which is a lot of money, and I really appreciate that. But property isn't get rich quick, and I never promote it to be, right? It's a long-term strategy, and the way that you create wealth is to buy properties that increase in value over time, and you continue to collect cash flow every month, right? So you'll see that everything I do is about long-term thinking and delayed gratification. And if you really want to create wealth in your life, nothing's ever easy. Nothing is ever easy. There is no such thing as get rich quick. You have to put in the hard work, right? But the plan I'm about to share with you here is very achievable and very realistic, right? So let's say that you bought 10 properties, even if it took you 10 years. It's still 30 years quicker than my dad, because my dad took 40 years to create that £1 million pension, right? Now, ultimately, you'll see in my first 15 properties, I was able to achieve this within 18 months. Doesn't mean to say that that's what you'll achieve it in or what you should be expecting to achieve it in. That's just what happened for me. But ultimately, anywhere between 0 and 10 years, this plan is going to be very effective for you, okay? So £40,000 times 10 properties, £400,000 of cash. However, when I'm using a buy, refurbish, refinance model, I typically leave half the money that I invest in and I take half of it back out so I'm able to refinance it, which basically means of this 400,000, if I times that by half, okay, it basically means I only need £200,000 of cash to invest to buy 10 properties, okay? Because I'm going to keep reusing the same money. And if you don't understand what buy, refurbish, refinance is, again, in my channel, you can find a video all about the buy, refurbish, refinance model, and it breaks down the numbers for you, okay? Now, this is effectively saying that each property is giving me a 15% return on investment. So we take the 250, we times that by 12 to get our gross rental income. We divide that by 20,000 and we times it by 100, and that gives us our return on our investment, okay? Now, the next thing that you can do is you can basically, I would buy 3 HMOs, okay? Now, if I brought 3 HMOs, roughly each one is going to make me a net income of around about £1,000 a month, right? Which would give me another £3,000 a month of net cash flow. Now, on a scenario like this, where I'm using £100,000 of cash, right? Sorry, I'm basically saying that you would spend £100,000 per property. So if you bought 3 HMOs, roughly at around 250,000 each, you're going to spend around about £100,000 on those properties, buying them with the legal, stamp duty, the deposit, and a bit of refurb to convert the properties, okay? Now, £100,000, if we times that by 3, that means we need another 300,000 to buy 3 HMOs and add those to the existing 10 buy-to-let properties that we have. Now, again, using that buy, refurbish, refinance model, I'm only going to need ultimately 150,000 to do it, because I'm roughly going to leave 50,000 in each one. I'm going to take 50,000 back out if I used a 300,000 investment. So actually, I could use 150,000 pounds to get the same outcome as if I invested 300,000 pound and just left 100,000 pound in each property using that buy, refurbish, refinance model. Okay, so typically I find that I would leave around 50,000 pounds in a deal for £1,000 in net cash flow these days. Okay. At the time of this recording, that's roughly what I see in the market. Now, based on those numbers, okay, you would effectively achieve an 18% return on investment, okay? And how do you calculate that 18% return on investment? Again, you take the take the £1,000, times that by 12 to give you 12,000. You take the 12,000 and you divide that by £50,000, and then you times that by 100, and that will give you your 18% return, okay? Now, the next thing that you need to do is then calculate all of this out. So if I brought 13 properties, 10 buy-to-lets, and 3 HMOs, and I bought 13 properties within a 10-year period. I mean, you might buy 13 properties in your first year. If you're somebody, honestly, if you've got around £300,000 of cash as a lump sum to start with, and you've been in corporate employment for a while, or you've got £1 million pension or close to £1 million pension, you're thinking about taking the tax-free lump sum out, then you could effectively, I think you could execute a plan like this if you had the cash available to you within a 12 to 24 month period. For those of you who don't have that cash, don't worry, because if you just were able to buy one property in 13 years' time, one property a year in 13 years' time, you would have executed this plan. Again, roughly 3 times quicker than if you just waited and paid all of your money into a pension and got £1 million pension at the end of your 40-year working life, right? So if we take that, ultimately we take the £3,000 that we get of net cash flow from the HMO plus £2,500 from the buy-to-lets, we end up with a net cash flow of £5,500 per month, right? Now, a lot of people think, great, I'm making £5,500 per month. But what they forget to do is they forget to take off voids and taxes, okay? Now, ultimately, because I'm conservative, I would say my portfolio is not always going to operate at 100%, right? So I'm going to take 5,500 and I'm going to times that by 75% in order to give me some built-in contingency into my model for things that go wrong in the year, for any extra maintenance that I have, for any kind of nuances that happen. Maybe a tenant leaves early and doesn't pay the rent, and for the turnover of the HMOs. I'm going to allow 5,500 times 75%, which will give me a net income of £4,125 per month, which is great, is awesome. But off that £4,125, we've got to pay taxes. Now, guys, I'm a big fan of using directors' loans accounts. I think, honestly, property is the most tax-efficient vehicle in the UK, hands down, period. And again, I've got a video called how to use a director's loans to pay no taxes when you're building your portfolio, okay? So you can go and check that out on my channel where I talk all about director's loans. So if you don't know what a director's loan is, again, go and watch my videos around that. It's a separate subject area. But ultimately, if you had £300,000 to start this journey and you put that into the company as a director's loan, or you saved £30,000 every year and you bought your properties in the company and the money went in as a director's loan account every year, you are not going to pay taxes on your portfolio for a long time, and therefore you can draw this £4,125 of income out of the portfolio every single month completely tax-free, okay? Now, for the purpose of this conversation and saying that you have to pay 20% taxes, and I'm going to put 20%, okay? The reason I'm putting 20% is because I'm saying you're buying them in a company. And if you can't draw them out tax-free, I'm going to explain that in a second, how we can take off the dividend taxes in a minute. But the first thing I'm going to do is I'm going to take the £4,125 and I'm going to times that by 80%. Now, why am I going to times that by 80%? Because if I buy them in a limited company, at the end of the year, I'm going to have to pay 19% corporation tax, okay? So I'll times it by 80%, roughly just to take off that 19-20% that I'm going to pay at the end of the year. It's actually 19% corporation taxes, but I'm going to take 20% off again. I'm always being a bit conservative, which gives me £3,300 a month of net income. That's net, right? Now, ultimately, again, in property, you have something called capital and revenue expenditure. And again, I have another video on my channel about this. I've got lots of videos. Property is such a big subject area. There's lots of specialist videos that I've got that will help you through all of these things. But in property, you have something called capital and revenue expenditure. Now, if you're using a buy, refurbish, refinance model, you can offset a lot of capital expenditure on the balance sheet in the early years. So you could be making £4,000 a month and show a loss at the end of the financial year, okay? And again, don't worry if that doesn't make sense to you. There are lots of videos on my channel around tax. You're going to see I'm a real big advocate of tax, and I ultimately say it doesn't matter how much money you make, it's only important how much money you keep, and not the money you keep that you can multiply. Again, I'm a huge advocate of tax for that reason, because I want to keep my hard-earned money, and in my channel I've got lots of tax videos that will explain all of that. So in this example, you get $3,300 in net income per month, okay? Now, if we again, like I say, if you don't pay taxes, you're at 4,000 a month, and ultimately you wouldn't if you implemented a buy, refurbish, refinance model, because you'd offset your capital expenditure. But for the purpose of this, we're going to take off 80% and be real pessimistic and be real conservative. So anything is a pure upside. So we take that 4,125 times 80% is 3,300, and then we take 3,300, okay, and we take off our dividend tax. Now, dividend tax is at 7.5%. So take the 3,300, we multiply that by 7.5%, which means that we pay £247.50 in taxes every single month, okay? Now, that effectively is 3,300 minus your 7.5% dividend tax, which equals £247.50 to come off the 3,300, which would equal £3,052.50 per month. Okay, and ultimately you can see that 3,000 is still more than my dad's £1 million pension, where he's making 2,600 a month. So in this example, if you bought 13 properties, 10 buy-to-lets at 100,000, 3 HMOs valued at around 250,000, you are going to end up with 3,000 a month off a 350,000 investment. The 200,000 up here and the 150 to buy the buy-to-lets. Okay, sorry, the HMOs. So that is what I would do if I had to start out all over again. Now let's look at this, because property, the way you create wealth in property, okay, is all through the compounding effect. So what we need to look at is, what would this property portfolio be valued at? Now, I roughly think that a portfolio, if you bought 13 properties, would be valued at anywhere between 1.75 and £2 million, okay? Right? Now, I'm going to work on £2 million again, just because I'm going to say that it was more expensive. Now, if I brought 10 properties at 100,000, that's £1 million. 3 HMOs at 250,000, that's another 750. That's 1.75. I'm going to go at 2 million to allow a bit of a buffer and a contingency if you bought them for slightly higher. Okay, so let's work off 2 million, right? Now, this is the great thing. This is where you're going to see you can get incredibly wealthy through property, because you make money in the long term from the assets going up. And this is how you create long-term wealth. So we have to allow for capital growth. Now, if we take 2 million and we allow for 3% capital growth every single year, so CG is capital growth every year for 10 years, this is what it's going to look like. And here's the maths, okay? If we allow for that, so we buy property, £2 million, and every year we're getting 3% capital growth. So on the 2 million, we get making 60,000 of capital growth in year one. Now, in the top left-hand screen here again, you're going to see the calculation of how to work out your compounding effect at 3% a year on your house prices. If you got 3% a year at over 10 years, sustained on the portfolio value of 2 million. So in the top left here, you can see all those calculations. Now, basically what this means is, if you take 2 million times that by 1.03, at the end of the year, that will give you 2,060,000 of capital growth at year one. Then you take that 2,060,000 times it by 1.03 again, gives you the next figure. And if you keep timesing it by 1.03 for 10 years, again in the top left here, you'll see the calculation broken down. You'll end up at the end of 10 years with a portfolio value of £2,687,832. So not only are you making 3,000 net income a month from your portfolio, but you've also made another 657,000 of capital growth on top. Okay, now I think 3% a year of capital growth is very conservative. My portfolio's in the Northwest. It's gone up a lot more than that. I mean, had some properties that I bought for 138,000 just 5 years ago, currently valued at 299,950 today. Now, so I'm really working on conservative figures. Let's say 3%. Most people say, well, in the North, you only invest for cash flow. You never get capital growth. But that's not so true. You do see capital growth in the north of the UK. And if you look at the house prices on Rightmove, you'll see every 10 years that the house prices in most areas across the UK would have always been an upward trajectory, right? Now, let's say that we allow 5%, because I think roughly 5% is better. But actually, sorry, before we do the 5%, at year 10 as well, you're going to end up with an extra £78,000 a year, adding in capital growth you're going to add 78,000 a year of capital growth at year 10. okay? So at year 10, you're going to be adding 78,000 a year. That's going to be adding to your net worth. And again, the great thing about this is it's paying you cash for every month and it's going up in value. Now, if we did this at 5%, right, take the 2 million and we allow for a 5% capital growth, okay? So 5% a year of capital growth. This is what you're going to end up with, okay? You're going to take your 2 million and you times that by 5%. Now, at the end of that, if you do 2 million times 5%, in year 1, you'll end up with 2.1. Again, the calculations are just coming up so you can see how I calculated this every year for 10 years, getting that compounding effect. If you do 2 million at 5% every year, you're going to end up at the end of the 10-year period of £3,257,789, okay? And again, just to be clear on the maths, take the 2 million, times it by 1.05, gives you 2.1 million in the first year, £100,000, of capital growth. You take the 2.1, times it by 1.05, gives you the value at year 2, so on and so forth. Again, top left-hand screen here, if you look at those calculations, you'll see how that's worked out. But at the end of the 10-year, you'll see, look, 2 million your portfolio becomes worth £3,257,789 at the end of the 10 years. That means at year 10, if we look at the capital growth, you're going to be making £162,889 per year of capital growth after 10 years, which is phenomenal, right? So not only is your portfolio paying you £3,000 a month in that scenario net income, it's also paying you £162,889 a year of capital growth, okay? Now, not only do we have to do that, we also have to think about, rental increase, okay? What about the rental increase across the portfolio, okay? So if we allow for rental increases. Now, if we look at these 10 properties, okay, if we go back up to these 10 properties, okay, look at what they were making us, okay, they were making us 2,500 plus forget what I just said there. We're going to look at the rents. I was going to talk about the net income, but they're making £5,500 of gross income, okay, right, which was roughly 3,000 when we broke it down of net, okay. Now, let's say that the 10 buy-to-lets, right, all rented out at £650 a month, okay? Now, if we times that by 10, that means we get £6,500 a month of rental income from the 10 buy-to-lets, okay? Now, on top of that, if we have three HMOs, and roughly if each room, we have, let's say they're 3 5-bed HMOs, each room rents out for £400 in that HMO. That's 400 times 5 gives us 2,000 a month from each HMO. Okay, that's 2,000 times 3 because we've got 3 of them gives us 6,000. So 6,000 a month. Okay, of gross income. If we take the 6,000 plus the 6,500, so we take this 6,000 from the HMO plus the 6,500 rent that we get from the 10 buy-to-lets, we end up with a rental income every month of £12,500 a month. Okay. Now, remember, if these rents go up, every year rents roughly go up between 3 and 8%, right? That's the annual kind of mean across the UK. Every year they really rise between 3 to 8% in line with inflation, okay? And that's the great thing about property. Property is an inflation hedge. Your properties go up higher than the rate of inflation, and roughly your rents go up in line, or if not a little bit higher than inflation too. So if we take the rents going up at 5% every year, £12,500 a month, rental income times 5%, and we did that. We take the 12,500, okay, because let's turn this into annual, times by 12 gives us an annual rent of £150,000 a year of rent. Okay, now if £150,000 a year of rent bill goes up at 5%, okay, 5% on this, okay, that is £7,500 a year that the rents will go up as well. Okay, now on top of that, if we took, and then top left hand corner, full calculations, if we do 150,000 a year times 5% every year compounded for 10 years, at the end of 10 years, you will end up with your rents increasing to £244,334 a year. So at the 10-year mark, we have rents of £244,334 a year, and we end up with a portfolio that's worth, if it was at 5%, worth £3,257,000. Now, That's really how you create long-term wealth in property. That's the exact plan I would use, and this is how I'd plan it out to work out what I want to do. I'd look at the compounding effect of the properties I'm buying over a 10-year period. I'll look at the compounding effect of the rents from the portfolio I'm buying, and I'll look at the net income it's going to give me and the total value of the portfolio at the end of it. Now, if you work out that, you'll see if you brought those 13 properties, that's going to give you a very strong retirement plan, okay? Way in excess of the £1 million pension, and ultimately it's going to be paying you a net income of higher than that £1 million pension too. Now, like I said, if you've enjoyed this video, please hit the like button. It will really help me. It will help the YouTube algorithm and the YouTube gods bring more traffic so people get to see more of my videos. The second thing is, if you haven't subscribed already, hit that subscribe button, smash that subscribe button, and click the bell icon. You'll be notified every week because we upload multiple videos a week. So if you want to be notified, click the bell icon and get notified. And the other thing I want to say, guys, right now as well, coming up on the screen, you should be able to see a few videos. You'll see some videos that you can watch. One is my first 15 properties, so you can see the exact properties I bought, the first 15 properties I bought to create that £1 million pension and create a passive income that was over £100,000 of net income per year, based on £100,000 corporate salary, so above £5,000 a month net income. And you'll also be able to go to the video about directors' loans accounts, and you'll also be able to go to the video around buy, refurbish, refinance model and how to work that all out as well. Okay, so you can go out and watch those videos. It will really help you if anything didn't make sense in this video because I glossed over it. You can really go and see the details for those, for the taxes and everything. And yeah, thanks for watching, guys, and I'll see you in the next one.